Okay, so this next term is margin. And we talked about margin being, let's just read the definition here. So margin is the amount of money that a trader needs to put forward in order to open a trade. When trading Forex on margin, you only need to pay a percentage of the full value of the position to open a trade. So I put this little picture down here. We'll talk about this one later, but let's talk about this one. So when they're talking about margin, they're talking about we only have to put a small percentage down to open a trade. And the rest of it comes from borrowed money from the broker, which is leverage. So if we look at here, this is why leverage is so important. So if we had a leverage of 1-to-1 to trade $100,000 worth of currency, that's like a large one lot trade, we would need to have in our account, we would actually have to deposit $100,000. But if we have, 400 leverage or 500 leverage to trade a large amount of assets, whether it's currency or gold or stocks or whatever you're trading, to trade $100,000 worth of currency, you only need $250 of margin. That's a huge difference. So this is why you can see leverage is so important. So when we have a high leverage, we can trade larger amounts because we're borrowing money from the broker, and all we have to do is put a small percentage down. In this example, you can see. So with 400-to-1 leverage, we only have to put $250 of margin of our own money into the trade when we open a position. So let's read what margin call means. Margin call is a notification which lets you know that you need to deposit more money in your trading account or close the losing position in order to free up more margin. Margin call warns the trader that a stop out level is approaching. Normally it's at 100%. This normally occurs at 100% margin level. If no action is taken, the broker will automatically close the position at approximately 70%. It varies by brokers, but usually about 70%. So you'll get a margin call. So a margin call is they'll either, back in the day they used to call you, but they don't do that anymore. So when your margin percentage drops to 100%, and it varies per broker, but 100%, before they used to call you on the phone back in the day when you used to place trades on a phone, but now they'll send you either most likely email notification saying, hey, you're approaching the margin call level. That's why they call it margin call. And they're saying, hey, your available margin, free margin is getting low. Either deposit more money, or once it reaches what they call a stop out level. The stop out level is usually about 70%. And when it reaches 70%, that's when your trade is automatically closed, and your losses, whatever negative balance you had, will be subtracted. And so let's go to actual MT4 here and see what the heck I'm talking about. So I placed you can see here on the left, a one lot trade. That's actually a large trade. I don't suggest you ever do that when you're learning. That's more when you're a pro. But for this example, because we have, this demo account has $5,000, so I placed a one lot trade. It's a buy position. So if you look here, we have balance, we have equity, and we have margin, and we have free margin, and then we have margin level. So this is where the percentage we're talking about. So when this drops to 100%, right now we're at 3,000%. And that's because we have $5,000 deposited. We're actually $8 positive, and that's why our margin percentage is fairly high. But say this was going negative 100 or negative 200 or 300, this starts dropping. Your margin percentage starts dropping, and that's where we come to this. So when your margin drops to 100%, right now it's at 3,000%. When it drops to 100%, that's when you get some sort of email notification saying, hey, it's telling you that you're in a negative, your trade is negative, and your margin percentage is getting low. And you'll see as your free margin, it will start being really low. So right now, how this is computed, so you have your balance, and then margin. Margin is, and what was the definition of margin? Margin was how much the Forex trader you need to pay a percentage. The percentage we have to put down to open the trade. So because we have high leverage, we have a 500 leverage in this account, we only had to put $144 down to open a one lot trade. So that's a large trade. We only had to put $144 down, and that amount comes out of our balance, and that's where you get the free margin. So free margin is the margin subtracted from your balance. Also, you subtract any negative balance you have here. So if this goes positive, your equity will go up. So as if you go $2,000 or $1,000 or $100 positive, you'll see that your equity actually can go higher than your balance. So if you're at a $1,000 profit, your equity will show $6,000 and your balance will be $5,000. Until you close your trade, your balance will not change. So this is your floating equity minus your margin and minus your positive or negative balance here. So that's when you see equity, that has to do with how much money you have floating. It's a floating equity because you haven't. So right now it says 5,006, right? Because we're at $6 positive, and our free margin will adjust. But the main thing you want to look at is your margin percentage, because this is when we're talking about margin call. This is what I want you to know, and this is also has to do with risk management. So our first level of managing our risk is not placing large trades that are too large for our account, and we've already talked about that in previous chapters. So the second thing is a stop loss. When we set a stop loss, that's our second level of protection of our account. So when we start accumulating a negative balance, when we're not watching the trades, it'll automatically close. But say if if we didn't set a stop loss, or if our negative balance is going to exceed our balance, then you'll start seeing this margin percentage. So just keep an eye on this when you're trading. As this starts dropping, when we approach 100% approximately, we're going to get an email saying, hey, either deposit more money into your account or you're approaching the stop out level. And the stop out level varies per broker, but for this broker, it's approximately at 70%. I believe it's 70%. You can check with your broker if you want to know the exact figure. You can Google it, but I'm pretty sure it's 70%. So when it approaches 70%, that's saying that we're so close to being at a zero. Like this, if we're approaching 70%, that's saying that we're probably close to negative 4,500 or something. And why? Some brokers, you can get brokers that actually have the stop out level at 20%. But the problem with that is if you have a news event and price fluctuates really fast, like it drops down fast or it goes up high, and you get a large negative balance really quickly, well, the problem with that is if it goes quickly and the system can't quick enough close your trade, then you actually will owe that money. It's better to have it at 70%. Some brokers, like I was saying, has it at 20%. But if you have it at 70%, that means you're giving the system more time to close your account before you actually go beyond your balance. So you don't, if there's a big news event and some broker has a 20% stop out level, that means they have just 20%. So they have to close your trade even quicker. And when there's news events, price fluctuates really fast. And the broker's already told you in their agreement that you've signed when you sign up with a broker that you're responsible for any negative balance. And it's up to you to manage your your trade, your risk. You have to manage your trade, your risk. These stop out levels are protections not just for us, but mainly for the broker. Our protection is risk management through how we trade and using a stop loss. This margin call and stop out level, this is for the broker. This is to protect their funds because we are borrowing lots of money from the broker to be able to place these trades. And I prefer a slightly larger stop out level around 70% because that ensures that my trade will be closed and that I won't be responsible for any more losses than what I've deposited. So it's a good thing having a margin stop out level at approximately 70%. But that's how margin level and margin call works. I know some of you have maybe seen that on your trades, or when you have open trade. Some of you saw that. Maybe you didn't know what it meant. That's why I'm going over this. You can also, I want you to go to account history. So here it shows you, your trade, whether it's buy or sell, what position size it was, the stop loss, take profit. And here, it'll show you, I believe it's under, I don't think it's stop loss, I think it's around here. So when you get stopped out, or when you get, when the stop out level is hit, so when your free margin drops to 70%, you'll see an SO. It'll say SO, which stands for stop out level, and it'll show like a percentage here. So if you ever get stopped out, like some people, some students are trading with like, $10, $15, $30. I don't know. Some people are trading with small accounts. You can trade with any amount you want. You just use smaller trade sizes, right? When you're learning. So any amount you're trading with, but some people have traded with, one student was trading with $5 and their trade got closed automatically. And they were like, oh, what happened? I don't understand. Well, when I told them to go into their account history, they saw under here, it said SO, stop out level. So yeah, I always tell you to maybe trade with, at least, $50. That should be sufficient. I always say $100 to $200. That'll give you a decent amount of trades. You can use 0.01 lots. You can place small trades and, learn, slowly and start small. And, like I said in previous lessons, focus on 3x return. If you can get consistent with that, you have the ability to print money. So you don't need to start with large amounts. You don't need to take big trades. Don't get sucked into making big money because really it's all about percentage. If you can be consistent with taking small trades, making a certain X value, 3x value consistently, you'll eventually be able to print money and you'll be very successful. So just be aware that there's protections that the broker has in place to protect their money, and we also have to protect our money by using good risk management and stop losses. Okay, and on to the next term.